Obviously, journalists aren't accountants, but they should make friends with one, and quick. More numbers, and it was more pressure, and they'd release more numbers. It's a real sign when people are sloppy with their financial statements. Journalists understand how important data is for finding and proving stories. The data that companies put out are called financial statements. These financial statements include all sorts of stories that you will never find in press releases. Companies, depending on the country that they operate in, have to disclose in numbers and in words what they're doing with their own and other people's money. And this is a boon to journalists. The financial statement that most people talk about is the balance sheet. And on the balance sheets, assets equal liabilities plus equity. In plain language, it means what the company owns, its assets, are used to generate cash to pay off what it owes, liabilities, and the difference between them is equity that belongs to the shareholders. Once you understand financial statements, you can use them to do all kinds of things, like follow assets that people are trying to hide abroad. You can see if a company sets up shell companies in 8 different countries and changes their names to try to hide assets. We here in our class learned how to read financial statements one day, and the very next day we looked at a Greek company, Folie, that's been accused of fraud. We looked at British filings, we looked at Greek filings, and you could see that the filings in Athens said this company was doing really, really well. The financial statements that we found in the UK said that the company was not doing very well. The company was losing money. And we could see journalists who had learned in 6 hours the day before that the company was owed 10 times what it sold that year from somewhere else in the company. All of these things raised red flags, which turned out to be true. And it wasn't hard to spot them in the financial statements. The basic financial statement is the income statement, or sometimes called profit and loss. This statement uses a company's revenue and expenses to determine its profit and losses. What's beautiful about this financial statement is with a little bit of division, a little bit of elementary school math, you can figure out the margins. You can figure out how well the company's operations are doing, and you can figure out where its sources of profits come from. For example, in 2017, Netflix doubled its profit. But if you look at the income statement and do that division, you can see that much of the change came from a little change in the tax law, whereby instead of putting money aside to pay taxes, it actually took money out of the pot. It's all perfectly legal. It was down to a change in how you account for stock that you give to executives, but it made a huge difference being able to take out money from your tax reserves instead of putting it back in. It helped Netflix double its profits. The third financial statement is the cash flow statement, and this is a thing of beauty. This is where the red flags pop out. They glow like stars against a night sky, because not everything that involves expenses uses cash. So a company has to unwind things where they book sales that don't involve cash, or where they book expenses that don't involve cash. So on the cash flow statement, you can very clearly see, for example, how much a company is paying to its executives in stock. In the case of Netflix, the company has given stock options worth some $800 million to its executives over the last 4 years. There's a fourth financial statement that uses numbers that aren't official. They're generally numbers that the company makes up and defines on its own, but they're very useful. It's called the segment results. And in this, a company voluntarily tells you what they're doing, broken down by different regions or by different divisions. It can tell you, for example, in the case of Netflix, how many subscribers it has, how many of them pay for their subscriptions, how many are given their subscriptions, how fast it's growing from year to year. And then they can come up with a number to show how profitable they are in each region without using the official numbers. So in Netflix's case, it wanted to show that it was doing really well abroad, that outside the United States, it was making money. So it invented a term called contribution profit. If you look at these numbers enough, and I've looked at them quite a lot, you can start to ask questions like, are they really putting the full cost of movies that are shown abroad into this calculation that they do? Are they putting the full cost of marketing to dozens of different countries into this number that they give out? Journalists can be skeptical and question the numbers, always asking somebody for help if you haven't studied it, if you're not an expert. But it looked a little fishy to me. And in fact, Netflix had to revise these numbers, and this quarter, announced they were getting rid of the metric.
And there's a lot of information available about companies.
There's a surprising amount of information available to journalists. And it's not just businesses. It's banks and financial institutions, it's foundations, nonprofits. Any organization that's using money, you can generally find a financial statement that will tell you an awful lot about how they're operating. The trick is that the financial statements can be quite long, and journalists are often uncomfortable looking through these numbers. So in a way, this is something to try at home, but we always have to verify it with people who spend their lives looking at these numbers.